Hi, Bitcoin is crashing and it's actually not really a surprise to me. I've been able to exit the market before the crash, and in this video I will share my exact approach of how I did it, together with a system of how to time a potential entry again. So when does it make sense to buy Bitcoin again? So of course nobody can predict the future, right? Nobody has an oracle that tells us where the price might go. But what we can do is we can use statistics, we can do backtesting, we can try to find out what kind of approaches at least worked in the past, and then use that kind of data to try to determine what is more likely to happen in the future. Because in the end, crypto is a game of odds. Nobody knows if prices will go up or down. But one might also argue that the likelihood of the price going up is not always exactly equal to the likelihood of the price going down, right? There is momentum happening. There are different data points that might help us determine certain probabilities. And so one thing I like to look at are moving averages. And the idea with moving averages is that they kind of represent the price movements while getting rid of this random fluctuations, right? We have these random up and downs, and the moving average tries to kind of ignore the daily ups and downs and just tries to distill the general momentum, the general trend. And so when using moving averages, the question is always, what's the perfect length? A lot of people just pick something randomly, right? They take maybe the 50-day moving average, maybe the 100-day moving average, and they use all kinds of different durations, but the signals you get are very different based on what kind of duration you take here, right? So one very straightforward approach of using moving averages is to simply try to be in the market whenever the price is above the moving average. So we ride the bullish waves, and then we are outside of the market when the price is below the moving average. So we try to avoid those crashes over here. We are only in the market when momentum is positive. Now this is where data and where backtesting comes into play. You can actually find out when you follow such a strategy, when you sell whenever the price is below and you buy whenever the price is above the moving average, you can backtest what kind of moving average length would have worked the best for Bitcoin, at least historically. And based on that result, you can then take the best moving average and trade accordingly. That's at least how I was able to exit around here, and I'm still risk off. I was not in the market while we crashed over here. And I hope with the results of this video, you can also avoid the next crash. So here again, let's drive this home. So what we've got over here is a long-term Bitcoin price chart. So in white, we see the Bitcoin price. In purple, we see a moving average, in this case, the 360-day simple moving average. And in gray, we've got a portfolio line. And when the price crosses this moving average, when the price is below the moving average, our portfolio line is completely flat. So we are in stable coins. In this backtest, I did not include that we might invest those stable coins, right? We would actually make some kind of yield over here. But I worked with no stable coin return, nothing like that, just very simple market timing. And so this is the approach, right? We try to be outside when things are bad. We try to be inside when momentum is bullish. And you can do this on all kinds of time frames, right? This is the 360-day. We could also do this with the 7-day, right? So now we have this moving average very close to the price, and we get in and out of the market very often. And in this example also, we outperform just buying and holding, right? This was the 360-day, but you could be way more active and do this according to the 7-day. Now, a problem with this approach is, with the backtesting, is that Bitcoin nowadays is very different to, say, 10 years ago, right? When it was just a few dollars. The kind of investors are very different. The volatility is lower. Right now, it takes way more money to move Bitcoin by, say, 5% than it did in the early days. So a lot of dynamics might have changed. So when we look at the moving average nowadays and we try to use what worked in the past, maybe we are not doing a fair comparison. Maybe we reflect the dynamics here in the very early days, but nowadays this same approach that worked in the early days might not work anymore. And so the backtest is a bit more complex. So bear with me, this is worth your time. So I have split up this backtest into 3 segments. So first of all, the entire history of Bitcoin, but then 3 segments, the first 4 years, the second 4 years, and the third 4 years, roughly, right? A bit more than 4 years. And so what we've got over here is the moving average duration in days. So this backtest is only looking at the price of the end of the day. So we are not looking at any intraday volatility. We just look at the end of the day, UTC time zone, midnight, what's the price? And then based on that price, we either buy or sell. And so we look at these moving average durations, and then we can see what was our annualized performance. Did we just buy and hold? So for Bitcoin during the testing period, this was 238% per annum. And then what kind of return would we get when we trade according to the moving average? By the way, in this specific backtest, I did include a bit of a trading fee, 0.1%. That's comparatively low. You can only achieve this on a centralized exchange. You might also achieve this, say, when you trade in and out with Curve Finance. There you've got 0.04%, but you do have a bit of gas. So you might have to check what kind of trading fee you have. You cannot use this kind of strategy if you've got like 2 or 3% trading fees. For example, on Coinbase, I think they've got quite high trading fees. You also have to consider taxes, which I fortunately do not have to because I live in Hong Kong. We don't have any capital related taxes. But yeah, this is simply just for timing the market and for simulating this with relatively favorable fees. So you need to have the proper setup. So when we look at the entirety of Bitcoin's history, the best moving average historically has been the 22-day moving average. If we look, however, at the first 4 years, we can see the results are slightly different, right? We've got a very good moving average here at the 16-day. The best moving average, though, would have been the 27-day. And that's why we want to split this up. There is maybe some kind of changeover here happening. The recent past, the last 4.5 years or so, are here in segment 3. And we can see here the 22-day moving average worked pretty well. The 23-day moving average also worked pretty well. It was the best among all of those moving averages. And that 23 also worked quite well regarding the entirety of Bitcoin's history, also in segment 1. In segment 2, we have a bit of an outlier here, right? The best was the 8-day moving average, but still 23 wouldn't have been bad necessarily, right? It would have still been better than a lot of what came before and after. And so the way I look at this, the 8-day is probably not working anymore, right? It only worked in one segment. It didn't work well in segment 1. It didn't work well in segment 3. So you can pretty much forget about the 8-day moving average. But the 22, 23-day, this seems to be a pretty good duration that worked throughout the entirety of Bitcoin's history. And so this is the same thing in graph form. So on the x-axis, we've got the moving average duration. On orange, we've got buying and holding. And in blue, we've got the annualized return by trading according to those moving averages. So that's total, that's segment 1, segment 2, and segment 3. So note that trading according to the moving average almost always resulted in better performance than just buying and holding. So there is momentum in crypto. Prices that tend to go up, they continue to go up, and prices that tend to go down continue to go down. So it does make sense to follow moving averages. You do get better performance, and you also get less risk in terms of downside, right? Because you exit the market whenever prices tend to decline. So this is a strategy that doesn't just randomly work for the 23-day moving average. It almost works for any moving average, right? As long as you go, say, beyond the 10-day and you don't get eaten up by those trading fees when you go too short term. So as long as you go beyond, say, 2 weeks, you can almost use any kind of moving average and you outperform buying and holding. But let's work with the best. Why not take the best? Let's look at the 23-day moving average, and that's what we have over here, 23-day. And so this is why I exited the market relatively early before we got all of this crash. I did buy over here and sell again, so I did have a missed trade. This does not work perfectly, right? When you look at the past, you do have failed signals over here. So by no means is this a perfect approach. It's simply another tool in your toolbox. But I think it's very, very much worth looking at. If you look at Bitcoin and you're considering to get in and out of the market, plot this chart together with the 23-day moving average. I can only recommend that. It worked very well for me. It's not the first time I exited over here. I also exited over here and I entered over here. But you have to look at the entire picture, right? If you're currently moving through a sideways trading range, then ignore those kind of signals. That's kind of like a little bit an art rather than something that I'm able to mathematically derive, but very often we can have kind of a feeling for this, right? When we went up, go down, went up again, then go down again, cross pretty much at the same level where we have traded before, then you can very likely often ignore these kind of signals. So that's one of my favorite ways to time the market. It's not my only approach, but it's definitely very, very helpful. And of course, if you've now fallen victim to this current crash, that's not pretty at all, but we are all in it to learn, right? To improve over time. And so if you're considering to get even more of this kind of useful content, to get even more backtesting results, or to learn how to make those backtests yourself, then feel free to check out the premium membership. So that can be found at thebitcoinstrategy.com. Link is in the video description. If you subscribe before the end of this month, you will lock in the current rate. Starting on February 1st, the rate will increase, but only for new subscribers. Of course, don't forget to subscribe because I publish videos regularly. And a like would be appreciated as well. There's also a public Telegram group. Simply search for Bitcoin Strategy Channel within the Telegram app. Be careful though, there are scammers trying to impersonate me. I will never message you directly, so don't fall victim for scams. Thanks for watching and see you next time. Bye bye.